Ladies and gentlemen, boys and girls, welcome back to Finance Tube. Your friend and finance guru Vishal Thakkar is back again with yet another video which talks about leverage. What is leverage? How does leverage work? Now, typically leverage is a principle from science, but we use it in finance. Leverage was originally discovered by Archimedes, and Archimedes was a scientist who was best known for making this statement that give me a place to put my apparatus and I will lift this earth with my 2 fingers. Let's understand what leverage is and how leverage works. Leverage is a concept where you can achieve more by putting in minimum effort. So leverage gives you efficiency. So to give a simple example, if you want to draw water from a well and if you just throw the bucket down and if you pull upwards, since you are pulling against the gravity, you will require a lot of efforts to pull the bucket up. But if you install a pulley onto the well and if you pull it down, if the rope is coming from the pulley and if you pull it down, you are pulling towards gravity and the effort required to draw water from a well gets reduced substantially. So this is basically the principle of leverage. Minimum input leading to maximum output. Now how does it work in finance? In finance there are 2 types of leverages, operating leverage and financial leverage. Let's understand each one in detail. Operating leverage is a concept of using your fixed cost to its maximum potential to bring down the total cost per unit of a product. How does it work? Let us say you have a factory in which you make t-shirts. Now, the rent of the factory is, let's say, 5,000 rupees. Every month, you make 1,000 t-shirts. So, what is rent per t-shirt? 5 rupees. Now, from next month onwards, you increase your capacity from 1,000 to 2,500. How much does it come to? Rent per t-shirt comes to 2 rupees. Now you increase your capacity to make 5,000 t-shirts next month. How much does rent per t-shirt come to? 1 rupee per t-shirt. Next month you make 10,000 t-shirts. 50 paise. After that you make 2 million t-shirts. Oh, sorry, that's China. That can't happen in India, right? So, point is that if you make 2 million t-shirts every month out of the factory which has a rent of 5,000 rupees, your rent per t-shirt is so negligible that you can actually bring down the price of the t-shirt substantially. Now, what I said is an extreme example, and I know that you will say, hey, there will be so many machines which are required to make 5 million t-shirts. What you are talking is absolutely ridiculous. You cannot fit so many machines in a 5,000 rent factory. I know. But my point is that economies of scale kick in because of operating leverage. Every business has certain fixed costs and certain variable costs. So fixed costs remaining fixed irrespective to the level of output. If you are able to achieve near maximum output from your given fixed cost, your fixed cost per unit comes down drastically. And once your fixed cost per unit comes down drastically, either it can lead to increase in profits or you can pass on this benefit to the customer by reducing the price of its products. So that is why Chinese products are cheap, because they are able to achieve economies of scale by spreading their fixed cost over very large number of units, and hence they are able to sell at much competitive prices. Let's come to financial leverage. What is financial leverage? Financial leverage is using own money and borrowed money in a optimum way within our capital structure to achieve maximum return on investment for our investors. Now this is technical. Let me explain in simple language. In simple language, let us say if you are putting your own money in business. If you had not put this money in business, you would have put this money somewhere in some other business which would have hypothetically assumed made you 30% return on investment. Now I know 30% is too high, but if you look at any manufacturing or trading business with the fast turnover, 30% is pretty much achievable. And you are borrowing from a bank to invest money in the same business, let's say at 12%. Now what happens is that your money has opportunity cost of 30% and bank has an interest cost of 12%. Let us assume this business also makes 30% ROI. In that case, let us say if you have invested 100 rupees and bank has interested 100 rupees, for your 100 rupees you will take back your 30. But for the bank, the 100 rupees which bank has given you, you will pay only 12 to the bank. The over and above 18, which is 30 minus 12, is the extra profit that you earn out of nothing. Because the 100 rupees that bank gave you, bank is very happy to receive 12 and forget the story. So when you borrow, your borrowing cost is fixed, and if your return on investment is higher than your borrowing cost, the extra profit that you earn by borrowing is nothing but financial leverage. That means you are using a low cost money to fund a high revenue business and get the spread for yourself or for your investors. So this in short is the concept of operating and financial leverage. For more concepts like these, stay tuned to our channel, and if you have not subscribed, please subscribe today. Our channel, Finance Tube. Systematic investment plan. What is an SIP? An SIP is offered by mutual fund